stop what you're doing right now because what I'm about to tell you could be the difference between a comfortable retirement and watching your nest egg crumble while Wall Street celebrates. I'm Kevin Ross, 15 years trading bonds on Wall Street, worked as an economist for a major firm, and now I spend my time helping families navigate what Wall Street won't tell them. Today's episode, the Fed just handed you a gift wrapped in a warning label. 99% of people are about to unwrap it wrong.
Yeah, Kevin, my phone's been buzzing all morning. Fed cut rates, market rally, all clear, but you don't look like you're celebrating. What am I missing here?
Well, Matt, when you've traded bonds through multiple Fed cycles like I have, because I'm so old, you learn to read between the lines. 4.3% unemployment, inflation's still at 2.9%, and Powell's already cutting. That's not strength, that's preemptive damage control.
Before we deep dive, folks, if you want real market insights from someone who's actually traded through these cycles, hit that like button now. And if you're a financial advisor with clients asking tough questions about this market, you're going to want to subscribe because Kevin's about to decode what Wall Street won't tell you. All right, Kevin, break this down for us. Everyone's saying Fed cuts are good for bonds. You spent 15 years in that market. What's the real story?
So, Matt, here's what I've learned over the years trading hundreds of millions in fixed income. Fed's cut creates a temporary sugar high. All those with little kids know what that's like.
Right.
But the hangover is brutal. When Powell cuts, bond prices might pop short term, but you're locking in lower yields for years while duration risk explodes.
Duration risk. Explain that like I'm not a bond trader.
Yeah, that's smart. Thanks for asking that. So to me, it's simple. You buy a 10-year treasury today at 4%. The Fed cuts three more times, and suddenly your bond value swings wildly with every economic headline. You think you're being conservative, but you just signed up for a roller coaster with guaranteed lower income.
So, for our listeners in their peak earning years and those approaching retirement, what should they be thinking of?
Well, Matt, they should be thinking like institutional investors. So when I was managing bond portfolios, we have one rule: don't fight the Fed. Don't marry their timeline either. We used to watch Bernanke and I forgot the other guy's name now.
Greenspan.
Greenspan, thank you. How big their briefcase was. That was a thing back in the day. Everybody was watching on CNBC. How big is the briefcase? So we're all trying to anticipate and trade the bonds, preemptively. So right now, the Fed's telling you rates are going lower. Smart money hears that and asks, how do I lock in today's rates before they disappear?
And that's where these insurance products come in.
Exactly, Matt. The insurance companies are essentially offering you a better bond trade than the bond market itself.
With no downside.
Bingo.
All right, Kevin. So, walk me through this. How are insurance companies beating the bond market at their own game?
So it's all about duration matching and regulatory capital. Um, Insurance companies have a 20, 30-year liability, so they can lock in today's rates and guarantee them to you. They're not worried about next quarter's earnings. They're matching long-term assets to long-term promises. I kind of call it, they use mortality credits.
Right. So,
Whereas like
it's what's available right now that won't be available tomorrow.
well, right now, you know this because we've been talking about it.
Yep.
You've been getting phone calls. We've got a 6% guaranteed rate for 5 years, Matt. And when I was trading bonds, we'd kill for that kind of certainty. No credit risk, no duration risk, no reinvestment risk, just a 6% guarantee.
It's plain old compounding interest.
That's it, baby.
And
Tax deferred too, by the way.
exactly. Yeah,
It's
that's
an
right.
annuity, yeah.
And there's something about an 8.75% cap rate that
Yeah, so there's a 6-year fixed indexed annuity with an 8.75 cap, Matt. So in my trading days, we'd call that free money.
right.
You get the market upside participation with the floor that guarantees you never lose principal. So this insurance company is essentially writing you a put option for free. So they're locking, and here's the thing, they're locking in that 8.75 for every year for the 6 years. That's unheard of. It's
Right.
usually can change every year. So things that you bought 3 months ago, they may lower their cap rates next because of the rate environment. This one, locking it in.
Right,
You're gonna go, go, go,
8.75%.
go.
Yeah, that's double what, a 3 or 5-year MYGA is paying out right.
That's right. That's right.
And for our listeners who aren't familiar with options trading, what exactly does that put options and call options mean in plain
Yeah,
English?
you know how I kinda geek out when I start talking about the markets and options and all that. So, all right, so here's how it works. Here's what it means. You get to play in the casino, okay? But the house guarantees you can never lose your money. God, I wish that was I gotta go to Vegas in
I know.
November. I wish that's the way it worked.
That casino wouldn't be open
Yeah.
very long.
No, it wouldn't. Yeah, be closed. But every year the market goes up, you participate up to the 8.75% cap. Market goes down, you get a zero, not a negative. So if we got next year we're up 10%, we capped at 8.75. We lock that 8.75 in. Next year it goes down 20. We have a zero for that year, still with that 8.75% gain because of the so so you get that zero, there's not a negative. It's the closest thing to a financial free lunch I've seen in 25 years.
That's probably why it's so popular right now.
Exactly.
So, Kevin, you mentioned leverage earlier, but most people think leverage means borrowing money to buy stocks. What's the difference here?
Okay, so Matt, when I was on Wall Street, we used to leverage every day. I mean, obviously it was pretty sophisticated. It was institutional leverage. I was
Right.
in institutional bonds. But what insurance companies offer is essentially the same concept. You're leveraging their balance sheet, the insurance company's balance sheet, their diversification, their regulatory capital requirements. And by the way, the regulatory capital requirements on a bank is much more strenuous than the are on the insurance companies are much more strenuous
Right.
on the banks. I think the banks got to have like 10 cents on the dollar.
Right.
You, the,
90% leverage.
yeah, 90%. The insurance companies are dollar for dollar,
Right.
you know. So the capitalization is super safe.
Right. So let's break that down a little bit more because I have a banking background, but I'm sure most of our listeners do not.
That's right. So think about it this way: you give the insurance company $100,000.
Right.
They don't just put it in a savings account; they leverage that across their entire $100 billion portfolio. Their their actuarial science, their reinsurance treaties. You're getting access to institutional grade leverage without personal liability.
So, for our listeners in their 40s and 50s building wealth, how does that fit in there?
So I call it portfolio construction 101. Let's call it that. You use the insurance company leverage to create a guaranteed foundation. Then you can be more aggressive with your growth assets.
Right.
So when you know your retirement baseline is mathematically locked in, you can take calculated risk elsewhere.
And what about for people who are closer to retirement?
So it's even better. They get institutional leverage for income generation. These contracts with income doublers, if you need long-term care, your income doubles. That's what that means. It shows me that it shows me a bond or show me a bond that can't do that. So what I'm saying is if you are getting $100,000 a year from your your annuity with your income rider and taking income for 5 years, you're 75 years, all of a sudden you get unfortunately diagnosed with um,
Yeah,
all
Parkinson's.
Parkinson's,
Yeah.
like my mom. Um, that income, that 100,000 would double because now, as what happened to my mom, she couldn't do 2 of the 6 ADLs, and then all of a sudden she was starting to go into started with like a daycare, uh, for 5 hours a day, and then it was now she needed to stay at
Right.
a home, and then she needed, uh when COVID hit, then they moved her back to the house with full in-home care.
Right.
All of that with that doubler, which she had, that 100 went to 200 a year. So really took a lot of the financial pressure
Right.
off of them. You can't do that in the bond market. Trust me, I know the market. There's
Yeah.
nothing out there. You can't leverage that.
Yeah. Does a 401k double your
I
payment?
wish it did, but it doesn't.
How about like an E-Trade IRA?
Yeah, there you go. That's the one. Yeah, nothing out there. Nothing out there.
Yeah. So contractually, these folks are guaranteed to double their income.
Yeah, precisely.
Right.
Yeah.
Kevin, with your economics background, what's this Fed cut really telling us about the broader economy?
So, Matt, Powell's not cutting just because everything's great,
Right.
obviously. Now Trump's going to tell you everything's great,
Of course.
but that's not why they cut. Um, the labor markets are softening. Regional banks are still stressed, and commercial real estate's really a ticking time bomb.
Right.
So when the Fed cuts proactively, they're buying insurance against something they see that's coming.
And how does that connect to housing? Lower rates should help, right?
Well, marginally, housing affordability is still really brutal. Supplies are constrained and lending standards, they're tight. Um, so the real connection is opportunity cost.
Right.
Instead of trying to time the housing market or guess which way rates go next, smart money locks in guaranteed rates while they're still available.
So you're saying treat this kind of like a trading opportunity.
Yeah, exactly right. So when I was trading, we had a saying, markets give you windows, not doors. This guarantees windows open now. So in October, it closes. And unlike the stock market, it doesn't reopen next trading day. I used to do that um, on our mortgages because, rates were, I think my first 30-year mortgage was 9.75. Everybody
Right.
that was older than me, "Oh, you got below double digits?" I mean, that's the market we were in,
Right.
back in the
We almost got back
early
to
ni
that market.
we were coming there. We were talking 4 more years of the, prior establishment, we might have gotten there. But here's the thing, um, when Fed started cutting rates, people were refinancing. Well, there was a margin on coffee loans based on the spread on the 30 years. So I'm really confused there. But I was playing that market,
Right.
and all of a sudden I was able to leverage these banks and playing the institute, which I was doing on the bond market. I was doing it in the mortgage market. So there's those opportunities. You don't have to get that sophisticated, but treat it as a trading win.
Right.
There is some opportunities I think that are come here. I don't think this one cut's going to cause a massive housing shortage by
Right.
any
Yeah, I
stretch.
doubt it.
Yeah.
All right, Kevin, you've managed institutional portfolios. You understand rate cycles. What's the tactical move?
So first, you lock in this 6% guaranteed before October 1st gets here. In my trading career, I've seen rate environments change overnight. So when insurance companies offer these rates, they're pricing in where they think rates are heading. And this is a rate that's been around for a couple months. And I know for sure they're going to do it. And they just happen, like a lot of insurance, they have a certain time of the month that they're either adjusting rates, keeping them the same, either adjusting up or down. This company that I'm know of, they're the first of the month. So it's coming.
What about that 8.75% cap?
Well, that one is is I'm going to say grab it now. I'm not hearing that they're going to adjust that yet. If they don't, you're getting a free gift in October. I can tell
Right.
you that. I would act as though that might go away. I know I'm putting some of my own money in there because that's a pretty good rate for some safe money play. Um, so I'd say, Matt, grab it now. I've analyzed hundreds of structured products over the years. Caps this high in this rate environment are statistical anomalies. The insurance company is essentially betting they can generate enough return to pay you that 8.75 on the upside. Take that bet.
Right. And by the way, if your financial advisor doesn't know these products, you have the wrong financial advisor. Leave a comment. We'll find you.
Yeah,
We'll get you in
right.
touch with somebody that has access to the newest stuff on the market. Any other moves that folks should be looking to
Yeah,
make?
so think substitution, not addition. Don't add these to a bond heavy portfolio. Replace the bonds.
Right.
Redeploy that duration risk into equity risk where you're actually getting compensated for taking the risk.
And what about for liquidity?
So I've always said keep, 12 to 24 months liquid. That's portfolio management 101. But everything above that emergency fund, stop accepting bond market risk when you can get insurance company guarantees.
Right. So, Kevin, give us the straight talk. What would you tell someone who's still skeptical about moving away from traditional bonds?
So, Matt, like I said, I spent over 15 years in watching institutional investors, pension funds,
Mhm.
endowments, insurance companies themselves move away from traditional bond strategies, buying structured products, alternatives, anything that gives them the yield without that duration risk.
So, retail investors, they're basically just catching up at this point.
Exactly. They're always behind the eight ball. These tools that the institutions have been using for decades are finally available to individual investors, but here's the difference. Institutions have teams of analysts and risk managers. Individual investors need to get this right the first time.
And what's the biggest mistake you see people making out there?
Number one, and I know you've heard me say analysis paralysis.
I'm guilty of that myself, to be honest with you.
They overthink it, markets change, but the math doesn't. 6% guarantee beats 4% every single time. There's no maybe there. It's
Yeah,
not complex. It's just different from what their financial advisor learned 20 years ago.
right. So, Kevin, what about the advisors who are out there listening? How do they explain this to clients who've been told bonds are safe their entire lives?
I, I show them the math. I've run the Monte Carlo simulations. Matt, in the falling rate environment, guaranteed products outperform traditional bond portfolios 80% of the time. It's not my opinion, it's just mathematics.
So, if it's like a roulette wheel where 80% of it's red and 20% of it's black, and you get to bet on red every single
Yeah,
time.
yeah, exactly right.
How about clients who are worried about new products or new carriers, things that they're not familiar with?
Yeah, so annuities aren't new; they're ancient, actually. So what new is the rates and features that are available today? Insurance companies have been guaranteeing retirement income since before the stock market existed. This isn't innovation; it's evolution.
So, Kevin, if someone's listening to this and thinking, this sounds too good to be true, what would you tell them?
I'd say do your homework. I spent 15 years analyzing fixed income markets for a living. These numbers aren't marketing gimmicks, they're actuarially sound. They're regulatory approved and backed by companies with credit ratings better than most banks.
And if they're still sitting on the fence?
Well, the fence is pretty expensive real estate, in my opinion. Every day they wait, rates compress further, opportunities disappear, and time works against them. I've seen this movie before, Matt. The window closes and it doesn't reopen.
Kevin, let's get real about timing. October isn't some arbitrary deadline, is it?
Absolutely not. These insurance companies reprice these products essentially monthly, some on a quarterly based on their hedging cost and the treasury movement. So when October hits that 6% guarantee, and then maybe that 8.75 cap, it disappears. Not because it's marketing, but because of the actuarial math changes.
And I imagine some of these carriers are probably trying to eke out a little bit more return on their own investment come quarter four.
That's exactly right.
And so we're talking about literally a closing window. I mean, this thing is closing. There's just enough time to sneak something in.
Yeah, Matt. In my trading days, we'd see $1 billion opportunities vanish in minutes when market conditions shifted. This is the same concept, just on a longer timeline. But make no mistake, when it's gone, it's gone.
So what should people do right now, like today?
So here's what I would do. Got to listen carefully. If you're sitting there thinking, I should probably look at this, you're already behind. Smart money doesn't think, it acts on a mathematical certainty.
And give them the action steps, Kevin.
All right.
Some people need that kick.
That's right. Okay. If you're an advisor and you want to know how to position these opportunities with your clients, how to have the conversation, how to run the numbers, how to address the objections, type the word client in the comments right now. We'll send you an advisor playbook that's helping top producers across the country pivot their practices.
And for those individuals that are out there watching,
So if you want to lock in that 6% guarantee before October, not learn about it, not think about it, but actually secure it, type now in the comments. We'll get you connected with the exact products and the exact process. No sales pitch, no pressure, just a mathematical reality of what's available today versus what won't be available tomorrow.
And Kevin, what if somebody's still not convinced they need to act this quickly?
Matt, I've been doing this for 2 decades. Actually, it's a little more than that. I've seen people miss rate cycles, miss market opportunities, miss retirement security, all because they wanted to think about it for another day, another month.
And
Market doesn't care about your timeline. The Fed doesn't care about your comfort level. And the insurance don't care if you're ready to make a decision. They care about one thing, actuarial math. And the math is changing whether you participate or not.
so, what's it going to be for our listeners?
Well, option one, I say keep doing what you're doing. Hold those bonds, accept that duration. Hope the Fed doesn't cut rates too aggressively. Pray inflation doesn't come roaring back. Or option two, use the same institutional grade tools that pension funds and endowments use. Lock in mathematical certainty while it's available. Build an income foundation that doesn't depend on market settlement or Fed reserve policy.
Well, when you put it like that,
There's really no contest here, Matt. This isn't a choice between good and bad. It's a choice between mathematical certainty and financial hope. And hope is not a retirement strategy.
final call, folks. What's it going to be?
Advisors, type clients right now. Get the tools to have the conversation with the confidence and precision. Individuals, type now, right now. Lock in rates that won't exist next month. Everyone else, keep listening to the same advisors who've been working around telling you wrong things about bonds for the last 3 years, 5 years, 10 years, and just see how that works out.
Because when October comes,
The window closes, the rates disappear, and the only thing left is right.
don't let that be your story.
As always, it's so important to remember to plan life right.